How to build a dividend portfolio. In this video, we'll show you exactly how to build a dividend portfolio that can provide you with a steady stream of passive income. If you've ever wondered how to create a portfolio that works for you, generates consistent cash flow, and helps you achieve your financial goals, then you've come to the right place. Building a dividend portfolio is a smart financial strategy, and in this comprehensive guide, we'll cover everything you need to know, from selecting the right dividend-paying stocks to diversifying your investments. We've got you covered. We'll also delve into the importance of dividend growth, and we'll share some expert tips and strategies to maximize your earnings over time. If you've ever wondered how to create a powerful dividend stock portfolio that works for you, stay tuned because we've got something exciting to share. In the next few minutes, we're going to guide you through every step of building a rock-solid dividend stock portfolio. Whether you're a seasoned investor or just starting, you'll discover valuable insights that can potentially transform your financial journey. Imagine having a portfolio that generates passive income consistently, month after month. That's the goal, and by the end of this video, you'll have the knowledge and tools to make it a reality. The strategies we're about to reveal can lead you to a high-quality dividend portfolio that can change your financial future. First things first, what is a dividend stock? A dividend stock is a kind of stock from a company that regularly gives some of its profits to its shareholders. They can do this every few months, once a year, or even each month. Usually these profits are given as money, but sometimes they're given as more stocks. When a company gives out dividends in the form of stocks, it's called a stock dividend. Now, companies give dividends for different reasons. Some want to reward the people who invest in their company. Others want to get more people to invest in them or show they're doing well financially. For people who invest, dividends can be like a regular money income. They can also make the ups and downs of your investments not so extreme. Here are some examples of companies that pay dividends: AT&T, T, Coca-Cola, KO, ExxonMobil, XOM, General Electric, GE, Johnson & Johnson, J&J, McDonald's, MCD, Microsoft, MSFT, PepsiCo, PEP, Procter & Gamble, PG, Texas Instruments, TXN, Verizon, VZ. These companies have been giving dividends for a long time and often make their dividends bigger over time. Now, how do dividend stocks work? Imagine you have 100 shares of a company, and every 3 months they pay you 50 cents for each share you own. This means you get $50 as a dividend payment every quarter. If you choose to reinvest this money, it will help you buy more shares of the same company. Owning more shares means you'll get even bigger dividend payments down the road. Dividend stocks are a smart way to make money and increase your wealth slowly over time. But remember, they do have some risks. The amount a company pays in dividends can go up and down, and sometimes they might reduce or stop paying dividends altogether. Now let's talk about the advantages and disadvantages of dividend stocks. Let's start with the advantages. Regular income. Dividend stocks can give you a steady flow of money, which can be really helpful, especially if you're retired or need extra cash. Chances to earn more. Besides the regular payments, these stocks can also grow in value over time. That means you could make money from both the growing stock value and the regular payments. Diversify your investments. Investing in dividend stocks can make your investment mix more varied. They don't act the same way as other types of investment like bonds or commodities. Protection from rising prices. As time goes on, dividend payments usually go up to keep up with prices going up, so they can help make sure your money still has its buying power. Or the disadvantages, short-term bumps. Just like any other stocks, dividend stocks can jump up and down quickly. This means their prices can go up and down fast, and you might lose money in the short term. Dividends aren't guaranteed. Those regular payments aren't set in stone. Companies can decide to pay less or even stop paying altogether. They might do this for lots of reasons, like if they're not making as much money or if they want to change how they use their money. Not for everyone. Dividend investing isn't right for all investors. If you're saving for something in the short term, like buying a house soon, you might want to look for other investments that could make more money. In the end, dividend investing can work well if you want a steady income and a chance for your investments to grow. Just remember, there are risks involved, so make sure you know what you're getting into before you start investing in dividend stocks. Hey, before we continue, we want you to know that we're always making new content, so make sure you like and subscribe to our channel so you don't miss anything. Investing in dividends is pretty simple, okay? So here's how you do it. First, choose a company that gives out dividends. You can look at things like how much they pay in dividends and how strong their finances are, and some tools can help you find these companies. Next, if you don't already have one, you'll need a brokerage account. This is where you can buy and sell stocks. There are different brokerage companies out there, so make sure you check their fees and what they offer before you sign up. After opening your brokerage account, you need to add money to it. You can do this with a check, a bank transfer, or an electronic transfer. Now, with money in your account, you can now buy the stock you chose earlier. You can do this online or by calling or using a mobile app. You can get the dividend money you need to keep the stock until the ex-dividend date. This is the date when you have to be a shareholder to get the dividend. On the dividend payment date, the money will be put into your brokerage account. You can use this money to buy more of the same stock, spend it, or invest it in something else. It's pretty simple, right? Okay, so when you're thinking about where to put your money, there are a few important things to think about. These are some simple metrics and ideas to help you decide. 10-year average return. Look at how this investment did in the last 10 years. This gives you an idea of how well it did, but remember, it doesn't tell you exactly how it will do in the future. Dividend yield. Check how much of the investment's price comes back to you in dividends. Imagine a company's stock costs $100 and they pay you 50 cents every few months. That's 2% of the price coming back to you. Diversification. See if the investment is spread out in different things like stocks and industries. If it is, it's less risky. Expense ratios. Find out how much it costs to put your money in something like a mutual fund or ETF. They usually charge a bit of the money you invest as a fee. Total return. Look at all the money you get back from your investment, including any extras you make when the price goes up and any money from your dividends. Earnings per share (EPS). Find out how much money a company makes for each share of its stock. This tells you if the company is doing well. When you're thinking about where to put your money, think about all of these things. There's no one answer that's right for everyone. It depends on your money situation and how much risk you can handle. Moving forward, let's say you're setting your portfolio now. There are certain things we should avoid, and we'll delve into each of these in more detail. They include 1. Choosing good stocks. The main goal here is to earn decent dividends, not to magically turn your money into a fortune overnight, so you shouldn't take unnecessary risks with the companies. Instead, consider how profitable the company is now and in the future, how the company manages its assets. Is the company making more money than before? We call this earnings momentum. Consider important metrics like book value and P/E ratio, which show the real worth of the company. Diversify across different industries. 2. Economic ups and downs affect each industry and its stocks in different ways. For example, when a country that exports gasoline is struggling, the companies making weapons might be doing well. So it's smart to spread your investments across 5 to 7 different industries. 3. Prioritize financial stability over rapid growth. Choosing financially stable companies is often smarter and less risky, especially with dividend stocks. You can figure this out by checking a company's credit ratings, which tell you if they're good at paying back their debts reliably. 4. Keep payout ratios in check. Look for companies with a payout ratio of 60% or less. This means they're giving back less than 60% of their earnings to shareholders. This allows them to reinvest in their business and stay flexible during tough economic times. 5. Value companies with a history of increasing dividends. Companies that consistently raise their dividends over time are usually more dependable and durable. Seek out these types of companies among dividend aristocrats, dividend achievers, and the Value Line Investment Survey. 6. Reinvest your dividends. Reinvesting the dividends you earn can lead to more significant compounding growth. This results in a substantial increase in your net worth over the years. Also, there are 3 main ways to invest in dividends. Growing dividends. This means you invest in companies that regularly increase the money they pay to their shareholders. People who like this method think these companies are well run and financially healthy. Income from dividends. This is when you invest in companies that pay a lot of money as dividends. People who use this method want a steady income from their investments. Value dividend investing. This strategy is about buying dividend stocks when they're selling for less than they're really worth. People who do this believe they can get a good deal and earn a nice dividend. Each of these ways has its good points and bad points. Dividends can give you both income and a chance for your investment to grow, but these stocks can be a bit up and down in the short term. Income from dividends can give you a regular income, but these stocks might not grow up in value much. Value dividend investing can let you buy dividend stocks at a discount, but they might be more unpredictable compared to other dividend stocks. Hey there, before we reveal the dividend traps, make sure to tap that subscribe button and turn on the notification bell. This way you won't miss out on our newest videos. You can decide if you want notifications for just a few videos or all of them. It's your choice, and if you're using your phone, don't forget to enable notifications in your settings. When you're looking at dividends, be careful for dividend traps. Here's what to think about. price to earnings ratio, P&E ratio. If this number is high, it means the stock costs a lot compared to what it's earning. That might mean it's too expensive. Free cash flow. Make sure the company makes more extra money than it gives out as dividends. This helps you make sure they can keep paying dividends in the future. Debt to equity ratio. If this is high, it means the company owes a lot of money compared to what it owns. This can be risky. Remember, dividend investing is a long-term plan. The money you get from dividends can grow over time and give you financial safety. It's also a good idea to spread your investments in dividend stocks to be smart in today's market. Okay, that's it. Now it's time for you to take your action and start your journey toward building a high-quality dividend portfolio that generates consistent passive income. Remember that dividend investing is a long-term strategy, so patience and careful planning are key. Which of the 3 main ways to invest in dividends aligns best with your investment goals and why? Is it growing dividends, income from dividends, or value dividend investing? Let us know in the comments section below. And as always, don't forget to hit that like button if you found this video helpful, and subscribe to our channel so you never miss out on our latest content. And for more resources and links related to today's topics, be sure to check out the description below. Thank you for watching, and we look forward to reading your comments and engaging with you in the next video.